Hello everyone, Kent Slauson here. I'm a real estate agent and investor in Grand Junction, Colorado. Today, we're going to discuss the most common loan options for purchasing a residential property. Let's hop right in. I am not a lending officer and this is not financial advice. The purpose of this video is to point you in the right direction and to help you effectively communicate with your lender. So let's talk about your options. First and foremost, you need to understand that lending is all about risk. The more risk a lender has to take to provide you with a loan, the more expensive that loan is going to be for you. Keeping this in mind, loans can be broadly divided into two groups. Those groups are conforming loans and non-conforming loans. A conforming loan is called such because it conforms to guidelines set forth by the government-sponsored enterprises known as Fannie Mae and Freddie Mac. This is important because when your lending institution originates your loan, most of the time they are not planning to hold on to that loan for its entire duration. Instead, what they are going to do is sell your loan to Fannie or Freddie, who are then going to package several loans together into something called a mortgage-backed security, which is then typically sold off to investors. So, a loan being conforming is important because it means that that loan can easily be sold, thus reducing the lender's risk. And remember, less risk for the lender translates to a better deal for you. Conforming loans usually have lower fees and sometimes lower interest rates than non-conforming loans. So what constitutes a conforming loan? Well, the loan must be limited to $647,000 in most parts of the U.S., though this does vary by county. The borrower needs a minimum credit score of 620 and a maximum debt-to-income ratio of 43%, up to 50% in some cases. For a conforming loan, there is a minimum down payment of 3% and mandatory private mortgage insurance for anything less than 20% down. Now, private mortgage insurance is an insurance policy the lender makes you buy to cover them in case you default on your loan. It usually runs between 0.5 and 2% of the loan amount annually. Okay, there are 5 main loan types, and only one of them is conforming. Those 5 loan types are conventional, FHA, VA, USDA, and jumbo loans. You've probably heard of these terms before. The first loan type, a conventional loan, is usually structured to be a conforming loan, but it can also be non-conforming. And a non-conforming conventional loan will have higher fees and worse terms than their conforming counterparts. The other 4 loan types, FHA, VA, USDA, and jumbo loans, are all non-conforming loans. However, without these non-conforming, government-insured options, many people would not be able to qualify for a loan. And you will find that each of these loan types are designed to benefit certain groups of people. Now let's break down each of these 5 loan types so that you can decide what may work best for you. Let's start off with conventional loans, and we're going to be talking about conforming conventional loans. Remember, these are not backed by the U.S. government, unlike FHA, VA, and USDA loans. They do require private mortgage insurance with less than 20% down. However, that private mortgage insurance should drop off of your loan automatically when you reach 22% equity in your home. Conventional loans tend to have lower origination fees than most government-backed options. They also allow a buyer to purchase a home which may be in slightly worse condition than some of the government-backed loan programs. Conventional loans are usually best for people with high credit scores and money for a down payment of 3% or more. Next, let's talk about FHA loans. These are insured by the Federal Housing Administration and are designed to be easier to qualify for than conforming conventional loans. FHA loans require a credit score above 580, unless you can afford a 10% down payment, and then you only need a credit score above 500. They do have a minimum 3.5% down payment. The maximum debt-to-income ratio on an FHA loan is 50%. The maximum loan limit is usually about $420,000 in most parts of the country. However, again, this does depend on your county. An important factor to consider when getting an FHA loan is that they all have mandated mortgage insurance, and this lasts for the entire term of the loan with less than 10% down. You have to refinance to get rid of mortgage insurance on an FHA loan. Now, if you are able to afford a 10% down payment, then your mortgage insurance should drop off after 11 years. FHA appraisals also have additional requirements, such as an undamaged exterior, and yes, peeling paint counts. They need working utilities, no safety hazards, such as handrails missing on a staircase or exposed electrical wiring, and there is house flipping criteria for an FHA appraisal. What does this mean? Well, a home flipper has to wait 90 days from when his deed was originally recorded when he bought the home for it to go under contract with an FHA buyer. Additionally, if a flipper has owned the home between 91 and 180 days and is selling the house for 100% over his acquisition price, a second appraisal is likely going to be needed. So FHA loans are usually best for people with lower credit scores who are looking to get into a home that is not in need of major repairs. Next, let's talk about VA loans. These are mortgages backed by the Department of Veterans Affairs. They are only available to veterans, military service members, and surviving spouses. They require no down payment, no mortgage insurance, and they have good interest rates. They also have low closing costs, but you do have to pay something called a VA loan funding fee. This can range from 1.4 to 3.6% of the loan's value. This can be paid upfront or it can be wrapped into the loan. Now, VA loans are only for primary residences, and there are additional appraisal requirements similar to FHA appraisals, which we talked about previously. VA loans are typically the best option for those who qualify. Next, let's talk about USDA loans. These are mortgages guaranteed through the U.S. Department of Agriculture and are intended to improve the economy and quality of life in rural America. They have zero down payment requirements, low interest rates. However, they do have strict eligibility requirements. To be eligible for a USDA loan, it has to be your primary residence, it has to be a single family home, meaning no duplexes, triplexes, etc. It needs to be under 2,000 square feet, in an eligible location. You need to be a U.S. citizen, and there are income limits as well as area loan limits. Additionally, USDA loans are needs-based, meaning mortgages are issued to those families deemed to be in the greatest need. So a USDA loan is usually the best option when both the borrower and the desired property qualify. Finally, jumbo loans. Jumbo loans are designed for loan amounts which exceed the conforming conventional loan limits. They require higher credit scores, we're talking 700 plus, there's cash reserve requirements, probably a 10 to 20% down payment, and they have higher closing costs. If you need to get a jumbo loan, you should probably ask your lender about piggyback options and adjustable rate options. Now that you understand your loan options, here are a few more helpful lending tips. If you can't afford the full down payment for your loan type, ask about down payment assistance programs. Here in Colorado, we have something called CHFA, which stands for the Colorado Housing and Finance Authority. They offer programs that assist with down payments for both conventional and FHA loans, usually in the form of a second silent loan. Utilizing CHFA potentially allows you to put as little as $1,000 down on a home purchase. However, please understand that in addition to your down payment, you will have to pay closing costs. Closing costs are the fees that you pay for services rendered throughout a transaction. Examples would be an application fee, a closing fee, credit report fees, lender title insurance, loan origination fees, etc. These fees vary between lenders and loan types, but in my area, they tend to fall between $3,000 and $6,000. Ask your realtor if seller-paid concessions is a plausible option to help you reduce your out-of-pocket closing costs, and review your closing statement for a breakdown of these fees. Next tip, use a local lender, as they are more likely to understand your local loan options and they are more easily held accountable throughout the loan process. Also, you're supporting your local community. Finally, get pre-approved before you go looking for houses. This will save you a lot of time and potential heartache. I hope this information has been informative. If you have any specific questions, drop me a comment or reach out to me directly. Please like, share, and subscribe. Thanks for watching, and I'll see you in the next one. Bye.